Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good morning, everyone. Sorry for that link issue. It was not set up for today because Saturday we generally don't have class, right? So today we'll have a 1 hour class. Okay, just to cover up what we missed in the last 2 days. Tomorrow onwards, again, we'll extend it to 2.5 hours and we'll, try to speed up things. Oh, sorry, not tomorrow, Monday. My bad, Monday. So today we'll able to see my screen. Okay. So today we'll finish up Accounting Standard 28. Accounting Standard 28 that deals with impairment of asset. Now, this is one standard which is slightly on the tougher side. It is slightly difficult, but nonetheless, can be scoring when it comes to examination, right? Now, when we talk about impairment, what this standard generally talks about is, let us say we have in the balance sheet some asset worth 10 lakhs. Okay, so let us say this is PPE. Now, whenever I'm representing an asset of 10 lakhs in the balance sheet, what am I saying indirectly is that in the business, when I use this asset or by selling this asset, I will be recover future economic benefits of at least 10 lakhs. That is why we show the asset at that value. Okay, like when you show inventory, you will show at cost or NRV, whichever is lower. So when I'm saying inventory is at NRV, I'm saying that at least whatever is the amount, let us say 1,000, I'll be able to recover from the inventory. Same way when I'm saying debtors, I'm saying that I'll be able to recover so much amount from debtors. Now, when we talk about impairment or impair, the word means loss. You would have heard about this term, hearing impaired, right? Impairment means loss. There is some kind of loss. There is some kind of loss that has happened or that is going to happen, for which Accounting Standard 28 prescribes what should be the treatment. Now, if I have a PPE and the PPE has worth of 10 lakhs, which is my carrying amount as per Accounting Standard 10, PPE is worth 10 lakhs as per Accounting Standard 10. But when I'm evaluating this PPE, okay, let us say this PPE is my car. I run a taxi business. When I'm evaluating this PPE, one thing what I realized is if I sell this, the selling price will only be 8 lakhs. So if I want to go and sell this asset in the market, I will be able to get only 8 lakhs. That is the first thing. Then second thing is if I use this asset, then in that case, when I use the asset, I'll get some cash flows. When I discount these cash flows, the present value is 7,50,000. This is the scenario. So one is my book value is 10 lakhs, my carrying amount is 10 lakhs. If I go and sell this asset, I will get 8 lakhs. And if I use it, I will get cash flows whose present value is 7,50,000. Now, it is not proper for me to show the asset at 10 lakhs because I will not be able to recover 10 lakhs. What is the maximum amount I can recover in this scenario? What is the maximum amount I can recover in this scenario? In this scenario, what is the maximum amount I can recover? I can recover 8 lakhs. So the standard says you cannot show this at 10 lakhs. You have to show this at 8 lakhs only. You cannot show it at 10 lakhs. You have to show this at 8 lakhs only. So this difference between 10 lakhs and 8 lakhs is called impairment of 2 lakhs. Impairment loss of 2 lakhs. Okay. Now we computed some numbers. 10 lakhs. This is called carrying amount. Selling price. The term used is net selling price. Net selling price means selling price minus cost to sell. So we have net selling price. This present value of cash flows is called value in use. So whenever you get a question on impairment, first you have to see what is the carrying amount. Then you have to see what is the net selling price. Then you have to see what is the value in use. Higher of net selling price and value in use is called recoverable amount. It is called recoverable amount. So carrying amount is the amount as per accounting standard 16 or accounting standard 26. Recoverable amount is higher of fair value minus cost to sell or selling price, what we call net selling price, and value in use, which is the present value of cash flow. So you calculate value in use, you calculate net selling price. Higher of the two is called the recoverable amount. And if carrying amount is more, if carrying amount is greater than recoverable amount, then we say it is impaired. If carrying amount is less than recoverable amount, then it is not impaired. So impairment loss is carrying amount minus recoverable amount. Recoverable amount is the higher of its net selling price and value in use. Value in use is present value of cash flows. Net selling price is amount obtainable from sale of asset between knowledgeable parties at arm's length transaction, less cost of disposal, or fair value less cost to dispose. Cost of disposal means the amount that you will incur to dispose of that asset. Okay, this is the concept of impairment. So whenever we have a question on impairment, we will see what is the carrying amount. We will calculate what is the recoverable amount. Recoverable amount is higher of net selling price and value in use. So comparing these two, we will see what is the impairment loss. Now, one more thing what the standard requires is directly you will not compute the impairment. First, you will see whether there are any indications of impairment. Now, what is the meaning of indications of impairment? Indications of impairment means what are the factors or what are the signs of impairment? Meaning to say, what has happened because of which we are saying there is a loss. Now, when I said my taxi business or car business, there could be losses or there could be indication of loss because, say for example, you are, there is more competition in the market, or electric vehicles have come because of which the prices have gone down. I am running petrol-based vehicles, and in the market we have electric vehicles. Now, because electric vehicles have come, it is difficult for me to survive to compete with the electric vehicles. So may be possible that valuation has gone. If I am in some technology business, new technologies might have come in the market, more competition in the market, government has changed the regulations, something like maybe COVID has happened. So there could be some or the other signs of impairment. The standard classifies this into external and internal indicators. External and internal indicators. External are like decline in the market value. So one could be the market value of the vehicle itself has declined significantly. That is one indication. Changes in technology, market, economic or legal environment which has adverse effect. That could be one problem. Increase in market interest rate. Now, generally what happens is when the market interest rate increases, the present value decreases. So that could be an indicator. Carrying amount of net assets is more than the market capitalization of the entity. So book value of assets is greater than what is the market cap. In the market, company is worth 100 crores as per the market. In our books, we have 150 crores of net assets. So this also could be an indicator, right? Then internal sources. Internal means something which is within the within the enterprise. Now, internal sources could be cash flows have been declining significantly. We are incurring continuous losses. Our budgets indicate that we may not be able to run at full capacity or recover the money. So we are seeing either obsolescence or damage of the asset. The car met with an accident. It could be impairment. Okay. Then changes in use or expected use. Initially, I had got one asset. I thought I will use it at 3 sites. JCB being used at 3 sites. Now I can operate only at 1 site. That would also be an indicator. So this is more important from your theory perspective for you to answer the question. Only when there are indicators, you will do the impairment testing. That is one thing you have to keep in mind. Then we said we'll calculate net selling price. Net selling price is basically selling price minus cost to sell. Simple calculation. Then we have value in use. Value in use is what? Present value of future cash flows. Present value of future cash flows. So we'll take the cash flows, we'll use the discount rate, and we'll arrive at the present value. As far as CA Inter exams are concerned, they will not give you detailed calculations on estimating cash flows. These future cash flows, whatever you learn as a part of your financial management, the same logic can be applied. Okay. For now, just understand that future cash flows includes your cash flows, cash inflows that will come minus cash outflows. Then you will also consider residual value. You will also consider residual value, which is the cash flow that you will receive when the asset is ultimately sold. Okay, based on what? Based on the given conditions, budgets of the management, and all of that, you will estimate the value in use. Now, some things which have to be excluded. What are excluded? If there is a liability which is already incurred, that you will exclude from calculating the cash flows. Okay. Then cash flows outflow that relate to obligations that have been recognized as liabilities already. Already, if you have incurred some liability, you have to pay that. So that is not related to usage of that asset. Okay. Same way, receivables, existing receivable. So if I'm estimating some cash flows on a particular date, I've already recognized some receivable. Money from this receivable will come whether or not I will use the asset. So this is no longer relevant. Only future cash flows are relevant. Okay. Then sometimes what happens is just for a point of understanding, there may be plans of management to do some modifications in and all of that. Means management might be thinking, management might be thinking that yes, there are problems. We need to resolve those problems. So we will take some action, we'll incur some expenditure in the future. If that expenditure is committed, then you will consider. If the expenditure is not committed, you will not consider. Then when it comes to discount rate, you will take the pre-tax rate. That is what you need to remember. So as far as this is concerned. Okay. Now, when it comes to impairment, once you have calculated impairment loss, in this case, impairment loss is 2 lakhs. This is, you will reduce the value of PPE, credit PPE, and you will debit impairment loss, which is a P&L item. So basically, impairment losses are debited to P&L. So how do we deal with impairment loss? Impairment loss are debited to P&L. Impairment loss are debited to P&L. That is the first thing. If this is when you are following cost model as per AS16 or AS26. Okay. Then if you are following revaluation model, then first impairment loss you will set off against revaluation surplus. First you will set off against revaluation surplus, then balance will be debited to P&L. So impairment loss, first, if you are following the cost model, you will debit the P&L. If you are following the revaluation model, you will set off against the revaluation surplus. If revaluation surplus is exhausted, you will debit the balance to P&L. So think of it like, if you are following the revaluation model, it is as good as a downward revaluation. Then there is one more scenario where you have something called as cash generating unit. Now, what is a cash generating unit? Cash generating unit basically comes in place. For example, if I have multiple assets, okay, if I have multiple assets and one asset individually cannot generate cash. One asset individually cannot generate cash. You need multiple assets. For example, I have production of milk and I need to package the milk. Just for understanding purpose, okay. I know I can sell milk independently, but for production, and I say production, let us say processing of milk. Production is based on your cattle and all of that. Once you get the milk, you process the milk, and then you have to package the milk, or process the milk to make ghee, butter, and package that thing. Now, if in the market, if I have to see for this processing of milk, so for production of milk, let us say I have one plant. And for packaging, I have a packaging machine. Okay. For packaging, I have packaging machine. Now, just by using this plant, I cannot generate cash flows. I have to compulsorily be dependent on packaging machine. So when a single asset cannot generate independent cash flows, see, in the example of a car, I need a car, I need the driver, and I need petrol. I can run the car, generate cash flows. But if I cannot generate cash flows from a single plant, I combine these two assets and call it cash generating unit. Cash generating unit basically is combination of multiple different assets. Cash generating unit is combination of multiple different assets. So when there is an impairment loss for a CGU, what you have to remember is first impairment loss you will write off against goodwill. Impairment loss you will write off against goodwill. Balance in proportion of carrying amount. What do you mean by that? Say for example, we have two assets and goodwill. Carrying amount is 100, 50, 50. Carrying amount is 100, 50, 50. This is 200. Net selling price I cannot determine for individual asset. So net selling price has been determined to be 120. Value in use, that is present value of cash flows, is determined to be 100 and let us say 30. Okay, 130. Now net selling price and value in use, whichever is higher is my recoverable amount. So recoverable amount is 130. Carrying amount is 200. Impairment loss is 70. Impairment loss is 70. Now, what do I do with this impairment loss? First, if there is goodwill, you will write off goodwill. So 50 minus 50, this will become 0. Minus 50 written off against goodwill, I am left with 20. This 20 you will allocate to A and B in their carrying amount ratio. So you will say 20 into 100 by 150 and 20 into 50 by 150. That is how you will allocate. Is this clear so far, whatever we have discussed? Any questions? Okay. Now, so far what we have understood? We have understood impairment is equal to carrying amount minus recoverable amount. Recoverable amount is higher of net selling price and value in use. After an asset has been impaired, depreciation is calculated on revised carrying amount divided by remaining useful life. Revised carrying amount minus residual value divided by remaining useful life. So let us see some questions. X Limited is having a plant asset carrying amount of which is 100 lakhs on 31st March of 21. No, sorry, first we'll do illustration one. This is first video. Then we'll come to the second one. Second one, you not. Second one you can practice on your own. Ergo Industries gives the following estimates of cash flows relating to PPE on 31st March. Discount rate is 15%. This is the cash flow. Residual value at the end of year 6 is 1000 lakhs. Okay. Now, property, plant and equipment was purchased on 1st of January of 20XX, 40,000 lakhs. So here we are doing calculations on which date? 31st December of year 1. Property, plant and equipment was purchased on 1st of January of year XX. We will see which year XX is. PP, useful life 8 years. Okay. Net selling price is 20,000 lakh. This is directly given. Calculate carrying amount at the end of year 1. That you have to calculate. Value in use, recoverable, impairment, revised carrying amount, depreciation. Now, year 20XX is the immediate preceding year before year 20X0. So, we are on 20X1. We are on 20X1. Then we have 20X0. XX is what? Is the immediate preceding year. So, XX is here. Means 1 year, 2 year, 3 years. Right? So, we need to calculate 3 years of depreciation. How much is the depreciation? 40,000 cost minus residual value 1,000 divided by 8 multiplied by 3. So depreciation is 40,000 minus 1,000 divided by 3 divided by 8 multiplied by 3. 14,625 lakhs is the depreciation. 40,000 is the original cost. 14,625 is the depreciation. So carrying amount is 25,375. Carrying amount is 25,375. Okay. Then value in use. Value in use is what? Present value of these cash flows plus residual value. Don't forget to consider residual value for present value calculations. All right. So present value of all of this plus residual value, you will get 46684 and residual value of 1000. Take the discount percent of 15%. 3 decimals are fine. Present value comes to 19025. Now, net selling price is 20. This value in use is 19025. Higher of the two will be recoverable amount. Recoverable amount is higher of value in use and net selling price, that is 20,000. What is the carrying amount? 25,375. 25,375 minus 20,000, impairment loss is 5,375. This will be impairment loss P&L to plant entry. Revised carrying amount is 20 lakhs, 20,000 lakhs. Revised depreciation, how much? 3 years are gone. Now we are left with 5 years. You will do 20,000. Don't forget the residual value minus 1,000 divided by 5. Are we clear with this question? Okay. This one for revaluation method. G Limited acquired a machine on 1st of April of year 0 for rupees 7 crore that had an estimated useful life of 7 years. So we purchased for 7 crore for 7 years. Machine is depreciated on SLM basis and does not carry any residual value. On 1st of April, the carrying value of the machine was reassessed at rupees 5.1 crores. And the surplus was taken to revaluation reserve. Now, what does that mean? 7 crores was the cost. When did we purchase? 0. When did we revalue? Year 4. How many years have passed? Year 0 to year 1. Year 1 to year 2. So, year 0 to year 1. Year 0 to year 1. Year 2. Year 3. Year 4. 4 years have passed by. So, out of 7 crores, we'll take 4 years of depreciation. Carrying amount is 3 crores. The value is assessed to be how much? 5.1. If the value is 5.1, 5.1 minus 3, 2.1 is your revaluation surplus. This is your revaluation surplus. Entry will be PPE debit, credit, revaluation surplus. For the year ended year 6, conditions indicating an impairment of the machine existed and the amount recoverable ascertained to be only 79 lakhs. Now, when did we see? We revalued on year 4, year 6, 2 more years have passed by. So now in these type of questions, you have to calculate carrying amount on 1st of April or 31st March of year 4. Then again carrying amount on 31st of March of year 6. Now here we have 5.1 lakhs. This 5.1 lakhs has remaining life of 3 years. Out of 7, 4 is gone, 3 years is left. So 5.1 divided by 3 multiplied by depreciation for 2 years, year 5, year 6. So that works out to 3.4 lakhs. Now what is the revised carrying amount? Revised carrying amount is, carrying amount is 1.7. What is the recoverable amount? 79 lakhs. 1.7 minus 79, 0.91 is your revaluation surplus. 0.91 is the revaluation surplus. Sorry, just a moment. I think I mentioned the wrong number. So, carrying amount of the machine, we have already taken revaluation surplus here, 3. So, I'm sorry, I'm just, got it back again. So carrying amount is 3. I don't know why am I misreading the number once. Just give me a moment. Once the link is broken, so 7 lakhs is the original cost. 4 lakhs we have seen. 4 crores we have seen is the depreciation. 7 minus 4, 3 crores is the carrying amount. We have revalued it to 5.1. So 5.1 is the revalued amount and 2.1 is the revaluation surplus. All right. Now on this 5.1, further 2 years of depreciation is 3.4. So that comes down to the 5.1 minus 3.4. You have carrying amount of 1.7. Carrying amount of 1.7. Okay. Now this carrying amount of 1.7, you will compare with the recoverable amount of how much? 79 lakhs. So 1.7 minus 79 lakhs, you have 0.91 of impairment loss. 0.91 of impairment loss. So what did we do? Original carrying amount, then revalued, then depreciation on the revalued amount, then we got the carrying amount. That carrying amount we compared with the recoverable amount, we got a loss of 0.91. Okay. Now, if you read this question further, G Limited has followed the policy of writing down the revaluation surplus by increased charge in depreciation resulting from revaluation. What this means is original cost based depreciation is equal to, for 2 years into 1 crore, you will get 2 crores. Depreciation based on revalued amount is equal to 1.7 into 2, that is 3.4. So the difference is 1.4. This difference we learn in age 16, right? The difference between the original depreciation and revised depreciation can be transferred from revaluation reserve to retained earnings. So what did we do? This original depreciation and revised depreciation, the difference between original depreciation and revised depreciation, 1.4 is transferred from revaluation reserves to retained earnings. It is transferred from revaluation reserve to retained earnings, which means out of 2.1, here you can see, out of 2.1, the revaluation surplus balance that we had calculated, 1.4 is transferred to revaluation reserve. If 1.4 is transferred to revaluation reserve, we are left with how much? We are left with 0.7 in the revaluation surplus. I am repeating once again. Total revaluation was 2.1. Out of that total revaluation, we have transferred 1.4 to retained earnings. So now we are left with only 0.70 in the revaluation surplus. Now, what is my total loss? Total impairment loss is 0.79. Total impairment loss is 0.79. Total impairment loss is 0.79. I have only 0.70 balance in the revaluation reserve. Sorry, impairment loss is not 0.79. Impairment loss is 0.91. Impairment loss is 0.91. Against that impairment loss, I have surplus of 0.70. So 0.91 minus 0.70, 0.91 minus 0.70, the difference I will transfer to P&L. So what will I do? 0.70 that you can see here, 0.70 I will transfer or debit to revaluation reserve. Difference that is left, 0.21, I will transfer to the P&L. Are we clear with this? This is one question which you should be, practicing before the examination as well. I just need to quickly again charge the pencil. Illustration number in our notes is illustration number 3. So, if revaluation is done, if revaluation is done, what we will do? First, carrying amount before revaluation, then carrying revalued amount. So let's say carrying amount before revaluation is 10,000, revalued amount is 1,20,000, 2,000 is revaluation surplus, 10,000 and 12,000. Okay. Then revised carrying amount based on revaluation for or till date of impairment. Means what? Now revalued amount is 12,000. On this amount, you will calculate depreciation. On that amount, you will calculate depreciation and calculate the amount as on date of impairment. Okay. So say for example, this 12,000, you have to charge 10% depreciation and it is happening after 1 year. So it is 12,000 minus 1,200, that comes to 10,800. Let us say recoverable amount is equal to, on this date, 8,000 only. So impairment loss is 2,800. Out of this 2,800, you will first utilize the revaluation surplus and balance will be transferred to P&L. But if the question says that from this revaluation surplus, we are transferring some amount to retained earnings, then what you will do? You will take original depreciation, 1,000, revised depreciation, 1,200, for number of years. Here it is 1 year for number of years. So the difference is 200. This will be transferred from revaluation surplus to retained earnings. Now, revaluation balance will only be equal to 2000 minus 200, that is 1800. So out of this 2800 of loss, 1800 will be written off against revaluation surplus and balance will be transferred to P. Are we clear? Others, are we clear? So for cash generating unit, first impairment loss will be written off against goodwill and impairment loss will be written off against goodwill and balance amount will be allocated to the respective asset. Now, as far as carrying amount of CGU is concerned, we will take all the assets that can be attributed directly or allocated on a reasonable basis to the CGU and we will exclude carrying amount of any recognized liability unless the recoverable amount of the CGU cannot be determined without the liability. Means, if there is any liability, you will exclude. But let us say there is present value of decommissioning cost. This present value of decommissioning cost is related to the asset. So that we will consider while determining the liability. Okay. Now, as far as goodwill is concerned, goodwill does not generate independent cash flows. Okay. So what happens is goodwill has to be allocated to CGU. Goodwill has to be allocated to CGU. Now, if goodwill has to be allocated to CGU, there has to be some basis. Now, the thing that you have to keep in mind in case of goodwill is, if goodwill can be allocated on reasonable and consistent basis, we will perform one test called bottom-up test. If it cannot be allocated on a reasonable basis, then we'll perform both bottom-up and top-down test. Now, what is the meaning of bottom-up test and top-down test? Bottom-up test and top-down test basically means if it is bottom-up, I am doing at each CGU level, CGU A, B, C. So bottom-up means I am evaluating A, B, and C independently. Now, if goodwill cannot be allocated, now when I am doing bottom-up test, to each of the CGU, I will also add goodwill. I will also add goodwill. But if I cannot allocate goodwill, then what happens is goodwill will be excluded. You will do only ABC based on their individual carrying amounts. Okay. Then, after performing this individual carrying amount, I will do something called as top-down test. That is, I will go to one level higher. Meaning to say, if there are 3 entities and goodwill, if I can allocate goodwill, you add goodwill for each of those entities and do the impairment testing. If you cannot add goodwill, then ignore this goodwill. First test A, B, and C, bottom level. First do the testing. Once the testing is done, then take A, B, C, and goodwill together. Go to the top level and then do the testing. Okay, that is called bottom-up and top-down testing. The best way to understand this is, say for example, there are CGU A, B. There are 2 CGU and there is goodwill. Carrying amount is 100, 150 and 50. Carrying amount is 100, 150 and 50. I can allocate goodwill to A and B. So what will I do? Allocate goodwill. Okay, on some basis. So let us say they have allocated in the basis of 30 and 20. Now my carrying amount will become 130 and 170. This I will compare with recoverable amount. Let us say recoverable amount for first entity is 110, for second entity is 180. Okay, individually you can allocate this. So when you do this, 130 is the carrying amount, 110 is the recoverable amount, 20 is the loss. Here 180, no loss because carrying amount is 170, recoverable amount is 180. This 20 of loss will be allocated against goodwill. So amount after impairment is equal to, for CGU A, assets 100, goodwill 10, 30 minus 20. For CGU B, asset 150, goodwill 20. So the total will be 250 and 30. Is this clear? This is called bottom-up test. This is called bottom-up test. You will allocate the goodwill and do the impairment testing. Once again, carrying amount is 100, 150, goodwill is 50. Goodwill can be reasonably and consistently allocated to A and B, 30 and 20. So I'll add goodwill 130, 170. Recoverable amount 110, 180. 130 minus 110, 20. 170 to 180, no loss. This 20 of loss entirely will be allocated to goodwill. If this loss was higher, I would have allocated to the other assets. After impairment, assets are worth 100, goodwill is 10, 150, 20. Is this clear? The bottom up approach? Okay. Now, say for a moment, this goodwill cannot be allocated. Goodwill cannot be allocated. If goodwill cannot be allocated, then what we will do? We will not consider goodwill. We will not consider goodwill. So what we will do? We will simply take carrying amount of CGU A, CGU B. Carrying amount was what? 100, 150. 100, 150. Then recoverable amount 110, 180. 180. At this level, if you see, you will see there is no impairment. Then you will combine all of this. You will go to the top level. You will take CGU A plus B plus goodwill. So because there is no impairment, carrying amount is 100 and 150. If there was impairment, you will take that carrying amount. Now, goodwill of A and B after bottom up testing is equal to 100 plus 150 plus goodwill of 50. Goodwill of 50. So this becomes 300. Recoverable amount 110 plus 180, 190. So not 190, 290. So impairment loss is 10. This 10 of impairment loss will be allocated against goodwill. This 10 of impairment loss will be allocated against goodwill. Are we clear? Now, here one more scenario could be possible. Sir, if this recoverable amount is, say, 90, then first you will have impairment loss of 10 here. And while doing this calculation, you will take 90 plus 150 plus 50, which is 290. And recoverable amount will be 180 plus 90. 180 plus 90, 270. Then there is a loss of 20. This 20 will be allocated to goodwill. First, you will knock off goodwill, then you will take to other assets. Okay. So this is there is one more question in the study material. You can practice that. Apart from that, no need to get into too much of depth of this particular topic. So we have done recoverable amount, carrying amount, value in use, net selling price, CGU. How do we allocate? How do we do when there is a top-down testing, bottom-up testing? Then we have something called as corporate asset. Corporate asset basically means assets which are related to head office and all, which cannot be allocated to a specific CGU directly, which are not related to specific asset directly or specific CGU directly. Now, treatment of corporate asset, for example, you have head office asset, common ERP systems, common computer systems, correct? So all of these are called corporate asset. Now, if you can allocate corporate asset to the CGUs, same treatment, you will perform bottom-up test only. If it cannot be, then you will do bottom-up followed by top-down. So first you will, and if there is impairment loss, first to goodwill, then to the other assets. Now, like we have impairment, we can also have reversal of impairment loss. So what is the meaning of reversal of impairment loss? If there is any indication that conditions have improved and I have to revive the impairment loss, I can reverse the impairment loss. Meaning to say, earlier we are written down considering it is a loss. Now we are thinking, no, things have improved, things have changed. Let us reverse the impairment loss. This also is possible only when the indication is there. Now, one very important thing, goodwill impairment will never be reversed. If goodwill has been reversed, goodwill impairment will never be, goodwill has been impaired, goodwill impairment will never be reversed. You cannot reverse it. Okay. Now, how do we treat the reversal of impairment? In case of individual asset, if you have taken it to P&L, you will credit to P&L. You will credit to P&L. That is the first thing. Okay. Second, if it was adjusted against revaluation reserve, If it was adjusted against revaluation reserve, then you will write it back to the revaluation reserve and balance will be recognized in P&L. So first, if it is to P&L, you will credit P&L. If it was set off against revaluation reserve, first you will restate the revaluation reserve and balance will be recognized in P&L, means credit to P&L. It is something like reverse revaluation, subsequent revaluation kind of a scenario. The second condition is like subsequent revaluation. So when there is a reversal of, when there is revaluation that is happening, what you will treat? Earlier revaluation, whatever has been written off, first you will credit that, then balance you will credit to P&L. Then balance you will credit to P&L. Are we clear? Then, if there is a reversal of impairment in case of a CGU, if there is a reversal in case of CGU, then goodwill will not be reversed. For remaining assets, you will take the carrying amount and you will reverse on pro rata basis. So like we calculated impairment on a pro rata basis, reversal also will be done on a pro rata basis only. Okay. Then there is one more thing that you need to keep in mind. Whenever we are reversing impairment, the reversal should not lead to the asset value being more than the carrying amount if there was no impairment. Now, what do I mean by that? It basically means, let's just show an example. Say for example, original cost 10,000, life 10 years, depreciation 10 lakhs divided by 10. After 2 years, carrying amount is 10 minus 1,000 into 2, 8,000. Recoverable amount, let us say, is 6,000. Impairment loss is 8,000 minus 6,000, 2,000. After third year, recoverable amount is, say for example, 7,500. Okay. Now carrying amount at third year will be 6,000. That is the total recovery. That is the amount at the end of the second year, divided by 8. That is the depreciation. So depreciation for third year is 750, which is 6,000 divided by 8. Carrying amount at end of third year is 6,000 minus 750, 5250. Now recoverable amount is 7,500. Impairment reversal is 7,500 minus 5,250, 2250. Now two things you have to keep in mind. Number one, impairment loss reversal cannot exceed the impairment loss. So I cannot reverse 2250. I can at the most reverse how much? 2,000 only. Second thing you need to check is, if no impairment, then cost is 10,000, life is 10 years. Carrying amount at the end of third year would have been 10,000 minus 1,000 of depreciation multiplied by 3, 7,000. So 7,000 is the recoverable amount without impairment, or carrying amount without impairment. Recoverable amount is 7,500. So what the standard says is, I cannot take it beyond 7,000. I have to restrict my calculation to 7,000 only. I have to restrict my calculation to 7,000 only. This is the maximum amount I can show my asset value. I cannot show it at 7,500. I have to show it at maximum of 7,000, and reversal should not exceed 2,000. So how much can I reverse here? Reversal actually can be 7,000 minus 5,250. Only 1,750 can be reversed. Are we clear? There is, no question as such given, but this is a simple understanding. You just need to calculate, if no impairment, what should have been the carrying amount. Okay, so that is it about impairment. Practice all questions from the study material. I have taken 2 varieties of questions already, and you can quickly have a look at this particular, kind of scenario. If at all it gets tested, read the disclosure requirement at least 2 to 3 times, because disclosure may be tested in the examination when it comes to impairment. Okay, and can expect a question. Be careful while calculating value in use. Okay, and in that example that we saw, periodic transfer of revaluation reserve to retained earning was happening. So be careful with that calculation as well. Okay, so we complete AS28 with this, and we'll resume on Monday with consolidated financial statements. Thanks a lot. Have a nice day.